Okay, let's unpack this.
Today, our mission, well, it's really about zeroing in on one core strategy: industrial consolidation.
Right, this idea of creating these huge corporate giants, basically to stamp out what they saw as chaotic competition.
Exactly. It's the strategy that really forged American capitalism as we know it.
And this philosophy, this drive for centralization, you see it perfected by the big names of the Gilded Age. People like Rockefeller definitely mastered parts of it.
But it feels like it was J.P. Morgan, the financier, who really turned it into a system, almost an art form. He institutionalized this creation of massive companies. Some might even call it, Morganization, his particular brand of consolidation.
Ah, okay, Morganization, not just merging, but engineering stability.
Precisely. And this whole approach, it defined the Gilded Age, didn't it? Leading to those extremes of wealth and poverty.
Yeah, and what's fascinating looking at our sources is how you can trace this line, this impulse for order and control from, say, 19th century railroads and steel.
Straight through to modern finance, even modern political organizing. It's a continuous thread, really, not separate chapters.
Okay, so let's start at the beginning then. Where does this consolidation impulse really take root?
I think you have to start with someone like Cornelius Vanderbilt. He's such a paradox.
How so?
Well, on one hand, he's almost the poster child for that old Jacksonian ideal, the self-made man rising purely on merit, building an empire from basically nothing, a real scrappy guy.
Okay, the American dream, sort of.
Exactly. But here's the twist. His incredible success, the sheer scale of his wealth, it kind of killed the very ideal he represented.
Because he became so big, nobody else could follow that same path.
Pretty much. He created such unprecedented wealth and power that he ushered in what historians call the era of great fortunes. It just fundamentally changed what opportunity even meant in America. He didn't just win the game. He rewrote the rules so that the kind of small-scale competition he started with became, well, almost impossible.
So where did he really flex this consolidation muscle?
The big move was when he took control of the New York Central Railroad. That's where his policy of, let's say, forced consolidation really kicked in.
What was it like before him? Just a mess.
Kind of, yeah. You had dozens of these small, competing rail lines. They often used different track gauges, couldn't easily connect, and they were constantly undercutting each other on prices. Just chaos from a business perspective.
Vanderbilt saw that as inefficient.
Totally inefficient. Madness, probably, to him.
Ooh.
So he didn't just negotiate mergers, he used his financial power to force them.
Like with the New York Central and Hudson River Railroad merger in '69.
Exactly. That wasn't just about streamlining. It was about achieving total dominance over that key route from New York City up to Buffalo.
Yeah.
One single, unified system.
Which meant more reliable service, sure, but for him...
For him, it meant stable prices, no more competitors driving down profits. That single act of consolidation was so defining, it basically gave its name to the whole era of big business that followed.
And it wasn't just about business structure. It became about family power, too, right?
Yeah.
The whole dynasty aspect.
Oh, absolutely. This connects back to those early fears about corporations in the American Republic. People worried they'd become like European aristocracies, passing down huge fortunes.
And Vanderbilt did exactly that.
He did. He passed the bulk of his empire to his son, William Henry. So the consolidation wasn't just about efficiency. It created this entrenched generational power.
Which must have really forced Americans to ask, wait, what happened to equality of opportunity?
Exactly. Suddenly, opportunities seemed tied to who controlled the giant infrastructure, not just who was willing to work hard. It was a fundamental shift.
Okay, so Vanderbilt sets the stage with scale and control. Who takes the next step? Is it Carnegie?
I think so. If Vanderbilt was about scale, Andrew Carnegie was about ruthless vertical integration for efficiency. His methods became the operational blueprint, showing just how incredibly profitable industrial centralization could be.
Vertical integration, meaning controlling every step of the process.
Every single step, yeah. His genius was designing his businesses to eliminate profit for anyone outside his system. He wanted to capture value at each stage.
Like the example with Keystone Bridge and Union Iron Mills.
Perfect example.
Yeah.
He invested in Keystone Bridge, which had these big, lucrative contracts with the Pennsylvania Railroad.
Okay.
Then, Keystone Bridge bought all its iron parts from another Carnegie company, Union Iron Mills.
Ah, I see. So the railroad pays the bridge company, Carnegie makes money. Then the bridge company pays the iron company, Carnegie makes money again.
Precisely. He's just moving money between his own companies. How could an outside supplier possibly compete with that on price? They couldn't.
It wasn't just about owning everything, though, was it? There was something else driving him.
Oh, absolutely. It was an obsession. Total obsession with cost.
Not profit.
Cost. According to Charles Schwab, one of his key guys, Carnegie always wanted to know the cost, not the profits.
Why? That seems counterintuitive.
Because profits depend on market prices, which
Yeah.
fluctuate, right? But costs are something you can potentially control, drive down relentlessly.
So if your costs are lower than anyone else's?
You win. You can dominate the market, even if steel prices are low, because your competitors simply can't afford to produce at that level. You drive them out of business.
How did he achieve those low costs in practice? Was it just the integration?
Integration was part of it, but it was also this incredible, almost microscopic focus on details.
Like what?
Like tracking the exact price paid for limestone, calculating the precise amount of coke needed per ton of iron, knowing exactly how long a piece of equipment should last before needing replacement. It was relentless measurement and optimization.
Okay, tracking inputs. But where did the biggest cost savings come from?
Ultimately,
Yeah.
labor. That was the input he could squeeze the hardest.
Which leads us directly to Homestead, doesn't it? The 1892 strike. That feels like the dark side of this efficiency drive.
It absolutely is. The Homestead strike was incredibly violent, a real turning point in American labor history. And its aftermath shows Carnegie's cost obsession in action.
What happened to the workers after the strike was broken?
Well, the ones who got rehired, the ones who weren't blacklisted, they had to agree to a new 3-year contract under brutal terms.
Which were?
The contract included a sliding scale for wages, tied directly to the price of steel. But crucially, with no minimum rate.
Wow. So if steel prices tanked, their wages could basically disappear. They bore all the market risk.
All of it. And on top of that, the new contracts made the 12-hour workday universal across the plant.
And where was Carnegie while all this was happening?
Safely tucked away in a castle in Scotland, actually. He spent his time giving interviews,
Seriously, what was he saying?
claiming he was basically retired, a full-time writer now. He even said he was working on a book about industrial problems,
Let me guess.
from the standpoint of one who had long retired from active business.
That's quite something, distancing himself completely.
It's a remarkable bit of self-positioning, isn't it? He seemed to genuinely convince himself that because he'd been both an employee and now this massive employer, he'd sort of transcended his own interests and could speak for everyone.
A convenient belief, perhaps, given the circumstances at Homestead.
Very convenient. It let him sidestep the direct moral fallout from the system he'd created.
Okay, so Carnegie perfects the efficiency model through integration and cost control, including labor costs. Where does the philosophy go next?
It evolves. Carnegie laid the groundwork, but I think John D. Rockefeller and Standard Oil took the philosophy behind it, the why to its logical conclusion. The explicit goal of eliminating competition altogether.
Not just outcompeting, but eliminating competition.
Yes, Rockefeller wasn't just trying to refine oil more cheaply than others. His real aim was to control the entire industry, the entire flow, and he largely succeeded.
Even with international competition, like from Russia.
Even then, by the late 1880s, Standard Oil still controlled something like 80% of the world market.
How? Just by being better.
Not just better, the core belief driving Standard Oil was pretty radical for the time. Competition wasn't healthy, it was wasteful.
Wasteful.
Because it led to price wars, unstable markets, companies constantly cutting corners and margins, leading inevitably to bankruptcies. It was inefficient, chaotic.
So, in Rockefeller's view, the solution was?
The trust. Establishing a comprehensive trust wasn't just about profit. It was seen as the only way to bring stability and rational order to an industry, eliminate the chaos of competition.
Order equals profit. Chaos equals loss.
That's the logic. And you see this thinking clearly when they look to competitors, like the Russian oil field.
What was their take on the Russians?
One of Rockefeller's key associates, John Archbold, basically said the Russian industry was doomed to be second-rate, not because they lacked oil, but because they failed to consolidate.
They couldn't organize themselves the way Standard Oil had.
Exactly. They lacked that prompt and energetic action, as Archbold put it, to suppress price competition and create a unified front. Their internal competition kept them fragmented and less powerful on the world stage compared to the American trust.
What was the mechanism Standard Oil used to enforce this? I mean, beyond just buying competitors out.
Well, the most notorious tool was probably the South Improvement Company scheme back in the early 1870s.
Right. Tell us about that. It sounds shady.
It was incredibly aggressive. The Sounds Improvement Company wasn't even really an oil company itself. It was essentially a front created by Standard Oil and a few allies
A front for what?
to make secret deals with the major railroads. The railroads agreed to give Standard Oil massive secret rebates on shipping costs.
Okay, lower costs for Standard. What else?
Here's the kicker. The railroads also agreed to charge Standard's competitors the full published shipping rates and then secretly pay a portion of that money back to Standard Oil as well. These were called drawbacks.
Wait, so Standard Oil got paid when its competitors shipped oil?
Yes. It effectively turned the railroads into spies and enforcers for the trust. They got detailed information on every barrel shipped by independents, and they made money off their competitors' business.
That's ruthless. It gave them near total control over transportation costs, didn't it?
Absolutely. And transportation was often the single biggest expense for refiners. It allowed Standard Oil to systematically bleed independent operators dry, forcing them to sell out or go bankrupt. It was consolidation by financial strangulation.
It seems like this level of control couldn't last forever, though. Didn't the government eventually step in?
They did. It took decades. But the Supreme Court finally ordered the breakup of Standard Oil in 1911, the landmark antitrust case. Everyone expected it to cripple the empire.
But it didn't quite work out that way, did it?
Not at all. It's one of the great ironies.
Right.
The breakup actually ended up making the shareholders, especially Rockefeller, richer.
How is that even possible? Busting the trust made it more valuable.
Yeah, it seems backwards, right? But think about it. The breakup didn't destroy the underlying efficiency or the market position of the component parts. It just split Standard Oil into 34 separate companies.
Okay.
Many of these new, smaller companies still held monopolies or dominant positions in specific geographic regions or specific parts of the oil business, like refining or pipelines or marketing.
Ah, so they were still powerful, just smaller targets.
Exactly. And crucially, they were now free from the constant threat of that one massive antitrust lawsuit hanging over the parent company. Investors saw this immediately.
They realized the pieces were worth more than the whole once the legal risk was gone.
Precisely. The market went crazy, bidding up the shares of these new independent Standard Oil company.
Like Standard Oil of New Jersey.
Yeah, its stock price shot up like a rocket from around 360 to nearly 600 in just 1 year after the breakup.
Incredible. And this is when Rockefeller's personal fortune peaked.
Yes, in 1913, his net worth hit about $900 million, which sounds like a lot, but need context.
Give us the context.
In that same year, 1913, the entire accumulated national debt of the United States government was only about $1.2 billion.
Wow. So his personal fortune, mostly derived from the pieces of the supposedly broken trust, was almost equal to the entire debt of the nation.
Pretty much. It's an astonishing testament to the sheer wealth-generating power of that consolidated structure, even after it was legally dismantled. The blueprint for value was just that strong.
Okay, so Rockefeller perfects the trust model, proving its immense financial power. Where does the story go from there?
Here's where it gets really interesting.
Uh-oh.
Because once industrialists like Carnegie and Rockefeller had proven these models worked, the focus kind of shifted. It wasn't just about building the factories anymore. It became about building the deals, the structure itself.
Enter the financier. Enter J.P. Morgan.
Exactly. Morgan wasn't an industrialist in the same way. He wasn't drilling wells or inventing new steel processes. His genius was financial architecture. He hated chaos, especially market chaos and competition, even more than Rockefeller, perhaps.
So his contribution was making consolidation systematic, professionalizing it.
Yes, institutionalizing it. He created the tools and structures to do this on an even grander scale. His approach, this Morganization, was about engineering stability through centralized financial control.
And the prime example of this has to be U.S. Steel, right? The sources point directly to that connection with Carnegie.
Absolutely. The creation of U.S. Steel in 1901 is the quintessential Morgan moment. Finance taking direct control of industry.
What exactly did he do?
He orchestrated the merger of Carnegie Steel, which was already enormous, with its biggest competitors like Federal Steel and National Tube. He bought Carnegie out for an astronomical sum.
Creating America's first billion-dollar corporation.
The first ever.
Yeah.
And Morgan's goal here wasn't primarily about making steel production even more efficient in the Carnegie sense. It was about stabilizing the market.
Ending the price wars.
Ending the price wars, ending the cutthroat competition that Morgan found so distasteful and, frankly, risky for investors. He created a corporate giant so big, so dominant, it could essentially dictate prices and bring order to the industry. Financial order.
So this model, the financiers stepping in to organize an entire industry, that's the legacy we see playing out later.
It's the direct ancestor, absolutely. You see this institutionalized in modern finance, especially in the world of private equity and leveraged buyouts, or LBOs.
Firms like Blackstone.
Blackstone's a perfect example. Steve Schwarzman and Pete Peterson actually got into the LBO game relatively late, around 1985.
But they became huge, didn't they?
Unbelievably huge. By 2007, they were managing something like $88 billion directly, overseeing another $50 billion in hedge funds. They essentially built a new kind of Wall Street powerhouse, rivaling the biggest investment banks, all based on this principle of acquiring and restructuring companies using financial engineering.
They took Morgan's philosophy and applied massive leverage to it. Can you break down the LBO model for us? How does it work and what's the risk?
Sure. The basic idea of an LBO is that the acquiring firms, say Blackstone, buys a target company, but they don't primarily use their own money.
Where does the money come from then?
Mostly debt. They borrow heavily, and crucially, they use the assets of the company they're buying, its factories, its cash flow, its brand, as collateral for those loans.
So the company being bought effectively pays for its own takeover.
In large part, yes. It gets loaded up with debt right from the start. That's the leverage part. It's a form of financial consolidation, using debt as the main tool.
Okay. And the risk?
The risk is baked into that leverage. If things go wrong, maybe the economy dips, the company's earnings fall, and the value investors are willing to pay for companies like it, the stock multiple, also falls, then the company's overall value can plummet.
And because it's so heavily indebted.
A drop in value, say by a third, could completely wipe out the equity stake that the LBO firm initially put in. It's high risk, high reward.
Yet Blackstone was known for being really aggressive with this, right? Even after downturns.
Very aggressive.
Yeah.
In 2003, for instance, when many rivals were still nervous after the dot-com bust, Blackstone was doing deals worth over $16 billion. They mastered the financial mechanics of consolidation.
This move towards financial engineering, valuing the structure over the actual making of things, it reminds me of what happened at GE under Jack Welch.
Oh, absolutely. GE is a fascinating case because it was the iconic American industrial company, directly descended from Edison, whose companies Morgan himself consolidated to form GE originally.
Right. And Welch?
Welch dramatically shifted his focus away from just making things. The big symbolic move was in 1986 when GE bought Kidder Peabody, an investment bank.
Why would GE buy an investment bank? It wasn't to build better jet engines, presumably.
No, it was explicitly to get a bigger piece of the action in the booming LBO business. Welch saw finance as cleaner, faster, more profitable.
There's that quote attributed to him, isn't there, about finance?
Yeah, that finance allowed you to conjure profits from thin air without the burden of messy factories or unionized workers.
Wow, that perfectly captures the shift away from the physical industrial side, eliminating friction, including labor.
And Welch practiced what he preached regarding labor friction, too. His whole management philosophy seemed to parallel this financial detachment.
You mean the rank and yank system?
Exactly. That policy of annually ranking all employees and firing the bottom 10%, regardless of overall company performance, it created intense internal competition and insecurity.
And it spread like wildfire through corporate America, didn't it?
It did, and it went hand in hand with a broader decline in worker power. Union membership plummeted during that era, from over a quarter of the workforce down to below 10% over time.
So, as finance became king, the value placed on traditional industrial labor decreased.
The data suggests that. While GE's stock soared under Welch, you often saw factory wages barely keeping up with inflation, maybe rising only 2% a year.
It feels like a modern echo of Homestead. Financial consolidation for the owners, cost restructuring, and precariousness for the workers.
It's a recurring pattern, isn't it? The drive for centralized control and efficiency, whether through industrial trusts or financial engineering, often has profound consequences for how wealth and risk are distributed.
Which brings us to the bigger picture, the macroeconomic consequences of all this accumulated, consolidated wealth.
Right. Because this isn't just about individual companies or fortunes. This century-long trend of consolidation and the increasing dominance of capital has reshaped the entire economy. Economists like Thomas Piketty have tried to quantify this.
He uses that formula, right? Beta equals S over G.
Beta steer. Exactly. Beta represents the capital income ratio, basically, how much total wealth, capital, exists in society compared to the amount of income generated each year. S is the net savings rate, and G is the economic growth rate.
Okay, so what's the core insight from that relationship?
The really crucial thing is how sensitive that capital-to-income ratio is to the growth rate. Even small changes in long-term growth have massive effects on the importance of existing capital.
Can you give an example?
Sure. Let's say an economy's long-term growth rate falls from, say, a modest 2% per year down to just 1% per year. According to the formula, that seemingly small drop would cause the long-term capital-income ratio to double.
Double, just from a 1% slower growth rate.
Yes. It means the total stock of wealth in that society would become equal to, say, 12 years of national income instead of 6 years. Society becomes twice as capital intensive, not necessarily because of new inventions, but simply because new income is growing more slowly relative to accumulated wealth.
And the consequence of that is?
The owners of existing capital automatically command a much larger share of the total economic pie. Inherited wealth, returns on investments, they become vastly more significant compared to wages earned from labor, simply because the denominator growth is smaller.
So slow growth inherently favors existing wealth holders.
Mathematically, yes, assuming savings rates stay relatively stable, and Piketty also points out this can lead to big international imbalances.
Like the example of Japan.
Japan is a classic case. They've historically had very high savings rates, but recently experienced a dramatic slowdown in economic growth.
Which means
Their capital-to-income ratio has ballooned. This leads to situations where a country accumulates vast amounts of capital, potentially far more than can be profitably invested domestically. So that capital flows abroad, buying up foreign assets.
creating these large international creditor and debtor positions, which can cause political friction.
Exactly. It's a consequence of these deep structural relationships between savings, growth, and capital accumulation.
And we see the human impact of this unequal accumulation starkly when we look at wage inequality, right? Especially comparing the U.S. to other places.
The contrast is really striking. If you look at, say, Scandinavian countries back in the 70s and 80s, their income distribution from wages was relatively flat.
How flat?
The bottom 50% of earners took home about 35% of total wages. The top 10%, they received only about 20%. Reasonably balanced.
Okay, now compare that to the U.S. more recently, say the early 2010s.
It's almost completely flipped. In the U.S. around that time, the bottom 50% of earners received only about 25% of total wages.
And the top 10%.
They received 35%. It's one of the most unequal distributions of labor income ever recorded in a developed country.
And the trends suggest it might get worse.
Projections based on those trends indicated that by 2030, the entire bottom half of the U.S. workforce could be earning only half as much, collectively, as the top 10% earns by themselves. It's a profound polarization.
So we've gone from industrial consolidation to financial consolidation, and now we see its effects in broad economic inequality. But there's one more layer of consolidation mentioned in the sources: political consolidation.
Yes, and it follows the same logic. Concentrated wealth doesn't just stay in the bank. It translates directly into concentrated political power. You see the creation of these highly organized, centrally funded networks that essentially function like private political parties.
And the Koch network is presented as a prime example of this.
It really is. By 2012, the Koch brothers had built a political operation so extensive, so well-funded, and so disciplined that it was seen as a genuine rival power center to the entire Republican Party establishment.
How did they structure it? Was it just donating money?
Oh, it was far more sophisticated than just donations. They applied almost an industrial logic to it. The sources describe it as an ideological assembly line.
An assembly line, meaning what?
Meaning they built interconnected organizations to handle every stage of the political process. Think tanks to generate the ideas and justification for their policy goals, advocacy groups to promote them, and crucially, a massive ground operation.
Including things like voter data.
Their own bespoke, state-of-the-art voter database, yes. Plus their own polling operations, funding networks to bring in hundreds of other wealthy donors, all coordinated centrally.
But wasn't it made up of many different groups? How was it centralized?
That was part of the strategy. They created or funded a coalition of about 17 distinct conservative groups, each designed to appeal to a specific demographic or focus on a specific issue.
Like
the Libre Initiative for Latino Outreach, Concerned Women for America targeting conservative women, Generation Opportunity aimed at millennials, and so on.
So it looked diverse, but the funding and direction were unified.
Exactly. It masked the central source of funding and control. They even had organizations like the Center for Shared Services to handle back-office functions like HR and IT efficiently across the network, just like a large corporation consolidating its administrative costs.
Leveraging the principles of the trust again, organize seemingly disparate parts into one powerful, centrally directed system.
Precisely. To maximize impact, minimize internal conflict or chaos, and achieve specific political outcomes, mirroring how Morgan sought to achieve financial stability through consolidation.
So what does this all mean when you pull back and look at this long arc?
That means that this core strategy consolidation, the drive to eliminate competition and impose order through centralized control, it's arguably the defining thread in the evolution of American capitalism and power structures.
From Vanderbilt consolidating railroads
Rockefeller building the oil trust.
to Morgan engineering financial control over industry with U.S. Steel.
And onward to modern financial firms, using leverage for consolidation and vast political networks, organizing ideology and votes. The goal remains remarkably consistent: stability and control achieved through centralization.
It seems the real genius then wasn't just inventing products, but inventing organizations, architecting power.
I think that's right. This whole history represents a shift away from that ideal of the small, scrappy entrepreneur competing in an open field towards a world dominated by these enormous, institutionally organized centers of power, industrial, financial, and political.
Which, as the architects intended, creates stability and generates massive returns for those at the center.
But as the statistics on inequality show, it also tends to concentrate wealth and risk in ways that create profound challenges for the rest of society.
You know, it's striking the sources mention how Andrew Carnegie, even after the brutality of Homestead, managed to convince himself he wasn't just acting in his own interest anymore. He believed he'd transcended parochial interests and could see the big picture for everyone.
Right, the self-justification of power.
So maybe the final thought for you, the listener, to chew on is this. Does the kind of vision and organizational genius it takes to build one of these modern colossal entities, whether it's a U.S. Steel, a Blackstone, or a Koch network, does that genius inherently allow the architect to actually transcend their own perspective and see the true common good?
Or is believing you've transcended your own interests simply an inevitable, perhaps even necessary self-delusion that comes with wielding that kind of vast, centralized power?